Hello smart investors and welcome to For Fair Value Investing. Today's stock is Raytheon Technologies, which trades with the ticker name RTX. Raytheon is a diversified aerospace and defense industrial company. The stock is up by 15% from its year low on March 23rd, and is down 45% from its year high on February 7th. In the last year Raytheon dropped by a whopping 40%, lagging the S&P 500 index by 48%, and over the last 5 years the stock dropped by 14%, lagging the S&P 500 by 70%. Let's check out what happened in the last 5 years. Revenue has been growing by an average of 6%, and we have been seeing double-digit growth since 2018. Operating margin is currently 12%, slightly lower than previous years. The number of shares outstanding is 864 million, which has been increasing since 2017 as the company needed to raise funds to maintain operations. Earnings per share has been growing by an average of 0.6%, lagging the revenue growth, because the cost of revenue has been increasing. Dividends paid out to investors has been increasing by an average of 4%, but it's unlikely for dividends to grow faster than earnings per share growth in the future, as the company already has a high payout ratio, as we're going to see in the next slide. We're missing the fourth quarter for 2020, but if we use analyst estimates we can see that revenue is down by 17%, highly affected by the slowing of the travel industry, which Raytheon is involved in the manufacturing of airplane parts, but we're expected to see an uptick in revenues for 2021. Out of 21 analysts studying Raytheon, we have 3 strong buy, 12 buy and 6 hold ratings. The firm's missile defense segment produces products that are prioritized by the National Defense Strategy, which should lead to consistent growth. Let's check out the fundamental indicators. It scores 2 for profitability, with 6% earnings growth over the past 5 years, 12% operating margin, and negative 7% return on equity, and negative 4% net margin. As we can see, the pandemic did not create a favorable business environment for Raytheon. The debt score is 1 with 10 billion in cash, total assets are 140 billion, and total debt is 95 billion, giving us a debt-to-assets ratio of 68%. The dividend score is 6, since dividend has been growing by an average of 4% for the past 5 years, and the current dividend yield is 3.6%, with a high payout ratio of 48%. For the valuation we have the score of 9, since the stock is undervalued by 24%, and in the last 5 years, on average the stock was undervalued by 7%. Let's check out the fair value history of Raytheon, and see where it stands now. As we can see, the stock is currently trading at its lowest valuation in 5 years. Raytheon is a perfect example of undervalued recovery stock, which the market oversold in the last couple of months. For the last 1 year Raytheon beat earnings estimates 4 times out of 4, and by an average of 72%, clearly analysts weren't expecting for the company's earnings to be this resilient. And for next year analysts are expecting for Raytheon to earn $3.26 per share. Now to get the target price we multiply future earnings with P/E ratio, which is a method of valuation. Currently it's trading for 8.4 times earnings, which is considerably lower than its 5-year average. Alright, if earnings beat estimates for the next year we might expect the price to reach 90. If earnings come up exactly as estimates we might expect to see the price at 74, and the best part is, even if earnings disappoint we should still see a higher price within the next year, because the stock is already beaten up, and has very little room to go lower. So on average the stock is expected to appreciate by 37%. And with a lower than expected earnings the stock might still appreciate by 15%. And as always, before you invest into a stock do your own research, and feel comfortable in what you're investing in. Always diversify across multiple industries. I'll be posting a lot of companies with high expected returns, and as long as you trust the fundamentals of the business, do not follow the herd and panic sell when you see a red day, or follow overvalued stocks, because everyone is buying. Alright, that's it for today. Thanks for watching, and please like and subscribe to my channel, and comment down below if there's a stock you're interested to invest in.